Silver collapses in a single session. 10% erased. Gold surges, then violently rejects. Bonds fall when they were supposed to rise. And in the middle of geopolitical tension, when capital should have rushed into safety, the traditional safe haven did something unexpected. Bloomberg published the explanation, but between the lines, something far bigger was revealed. This was not just volatility, it was a signal. A signal that capital may be quietly rotating, that the old crisis playbook may no longer work, and that the global definition of safety may be changing in real time. If that is true, then this silver crash was not the story. It was the warning. And the real shift is only beginning. Welcome to Boring Currency FX. If someone has been studying markets longer than many modern traders have been alive, then subscribing should not feel emotional. It should feel strategic, calmly, deliberately, like I'm adding a layer of protection before uncertainty expands. And let them share in the comments. Where are they watching from today? The session began with confidence. Silver opened firm, holding near recent highs. For a brief window there was stability. Then the pressure started to build. Selling accelerated in waves. Within hours, silver had fallen 10%. A move of that size is rare for a monetary metal. It forces attention from traders, institutions, and business leaders alike. At the same time, gold attempted something technically important. It moved toward a major resistance level that analysts had been watching closely. It touched that level, then it failed to break through. The rejection was sharp and fast. What appeared to be strength in the early hours turned into hesitation by the close. Many observers reacted emotionally. They saw silver plunge and assumed weakness across the sector. They saw gold reject and concluded the rally was finished. But experienced capital allocators do not stop at surface interpretation. They ask a deeper question. What does it mean when silver collapses, gold holds most of its structure, and government bonds do not behave as expected during uncertainty? That question defines the event. Silver is structurally more volatile than gold. It is thinner, more leveraged, and more sensitive to liquidity flows. When gold rises 3%, silver often rises 6 or 8%. The same relationship applies in reverse. A modest pullback in gold can translate into a sharp correction in silver. This is not manipulation. It is mathematics combined with leverage. During the recent session, gold declined only a few percentage points from its high. Silver amplified that movement. Futures contracts were liquidated. Margin calls forced short-term participants to exit. The speed of the decline created the appearance of systemic weakness. But systemic weakness leaves different footprints. In a true structural breakdown, capital exits broadly. Bonds rally sharply. Gold collapses below prior support. Confidence drains quickly across asset classes. That pattern did not fully materialize. Instead, something more complex occurred. During geopolitical stress, traditional financial logic suggests that investors should buy government bonds. Yields should fall as money seeks safety. That has been the pattern for decades. Yet during this volatility, bond yields rose. That means bonds were sold, not accumulated. This detail is critical. If bonds no longer absorb fear automatically, it suggests a change in capital preference. Inflation concerns, rising fiscal deficits, and policy constraints may be reducing confidence in long-duration sovereign debt. Meanwhile, gold did not collapse. It tested resistance and retreated, but it remained structurally elevated compared to previous weeks. That behavior resembles consolidation, not capitulation. For serious decision-makers, relative strength matters more than dramatic headlines. The silver plunge was visible and intense, but beneath the volatility, capital flows revealed nuance. Leveraged positions were unwound. Futures markets reacted quickly, yet broader trust in hard assets did not disappear. Entrepreneurs and business leaders should not dismiss this as routine fluctuation. Markets often reveal structural tension during periods of stress. When safe haven behavior changes, financing conditions eventually follow. If bonds struggle during uncertainty, borrowing costs may remain unstable. If gold holds strength despite rejection, it suggests persistent demand for assets outside the policy system. This session may not mark a definitive turning point, but it represents a stress test, and stress tests expose hidden weaknesses in financial architecture. The visible story was silver's 10% fall. The quieter story was capital questioning where true safety now resides, and that quieter story may prove far more important in the months ahead. For more than 50 years, the rule was simple. When the world became unstable, investors bought U.S. government bonds. It did not matter whether the crisis was geopolitical, financial, or systemic. Capital moved into Treasuries. Yields fell. Stability returned. That pattern built an entire generation of portfolio strategy. Pension funds relied on it. Insurance companies modeled risk around it. Central banks structured reserves around it. The assumption was clear. Sovereign debt issued by the United States was the ultimate safe asset. But in the recent turmoil, something subtle happened. Tension rose. Commodity prices reacted. Silver collapsed in a leveraged unwind, gold tested higher levels, and instead of rallying, Treasury bonds weakened. Yields moved up. This is not a minor technical detail. It challenges the foundation of modern financial architecture. When investors sell bonds during uncertainty, it signals that inflation risk is overpowering fear risk. In simple terms, they are more concerned about losing purchasing power than about short-term volatility. That is a profound shift. For decades, deflationary forces dominated the global economy. Debt expansion, globalization, and technological efficiency kept price pressures under control. In that world, bonds performed well during crises because inflation was contained. Now the environment is different. Energy supply disruptions, regional conflicts, and supply chain restructuring are creating persistent cost pressures. Governments are carrying record debt levels. Fiscal expansion has become normal, not exceptional. In this setting, bonds carry more risk than before. If inflation expectations rise even slightly, long-duration debt loses value quickly. Investors understand this. They see that central banks face a dilemma. If they raise rates aggressively, they risk recession. If they cut rates too soon, inflation may accelerate. This constraint weakens confidence in policy control. Gold, by contrast, operates outside this policy framework. It does not depend on interest rate promises. It does not require fiscal discipline. It does not rely on institutional credibility. It is simply scarce. That simplicity becomes attractive when complexity fails. During the recent volatility, gold did not collapse. It pulled back from resistance, but it held strength relative to bonds. That relative behavior matters more than daily percentage changes. Serious capital allocators watch relative performance. If gold begins to outperform bonds consistently during periods of stress, it suggests that investors are quietly redefining safety. This does not happen overnight. It happens gradually through repeated cycles. One weak bond reaction could be dismissed. Several in a row form a pattern. For business leaders, this shift has real consequences. If sovereign bonds no longer absorb fear capital, borrowing costs may remain elevated during crises. That changes corporate financing strategy. It increases the cost of capital. It compresses margins for debt-heavy enterprises. It also impacts currency stability. And when bond demand weakens, currency strength can erode. A weaker currency raises import costs and complicates global trade planning. Entrepreneurs must recognize that macro shifts are not abstract theory. They directly affect input prices, financing options, and long-term planning. The current moment may represent an early stage of transition. Central banks still hold power. The dollar remains dominant in global trade, but dominance can erode slowly before it visibly weakens. The recent behavior of Treasuries is not proof of collapse. It is evidence of strain. And strain in the system creates opportunity for alternative stores of value. Gold's role in central bank reserves has quietly increased in recent years. Emerging economies have accumulated metal to diversify away from pure dollar exposure. This trend did not begin yesterday. It has been building beneath the surface. When mainstream financial coverage focuses on short-term volatility, it often overlooks these structural currents. The deeper question is not whether silver fell 10%. The deeper question is whether the global definition of risk-free is being reconsidered. If capital begins rotating away from long-duration government debt toward tangible assets, the investment landscape changes dramatically. Portfolio construction models built on the bond-equity negative correlation must be reevaluated. In previous cycles, bonds rose when equities fell. If both decline together under inflation pressure, diversification strategies must adapt. Gold becomes less of a speculative hedge and more of a strategic allocation. For disciplined decision makers, the lesson is not to react emotionally to one day's movement. It is to observe patterns. Is bond demand weakening during stress? Is gold maintaining higher structural levels? Are central banks constrained by inflation risks? These questions define the next decade more than any single trading session. The silver plunge was visible and dramatic, but beneath that volatility, a quieter event may be unfolding, a gradual transfer of trust. Trust is the foundation of every financial system. When trust in policy tools weakens, capital searches for alternatives. If that search continues, the implications will extend far beyond metals markets. They will influence credit markets, currencies, and corporate strategy. Part 2 does not declare the end of the bond era. It identifies early signals of tension. And in macroeconomics, early signals matter, because once the majority recognizes a shift in safe haven preference, the reallocation is already well underway. In capital, once it moves with conviction, rarely moves slowly. Most market participants look at one number, the price on the screen. They assume that number represents reality. But experienced observers understand something important. In commodity markets, there are often two realities, the paper market and the physical market. The silver plunge forced serious analysts to examine this divide. On the surface, silver fell 10% in a single session. Futures contracts were sold aggressively. Stops were triggered. Margin calls accelerated liquidation. The chart looked decisive. It looked like weakness. But behind that chart sits a complex structure. Silver trades heavily on futures exchanges. These contracts allow traders to control large amounts of metal with relatively small capital. This creates leverage. Leverage increases both upside and downside volatility. A wave of selling in futures can push price sharply lower, even if no large quantity of physical metal changes hands. That distinction is critical. A futures contract is a financial instrument. It is not a warehouse withdrawal. It is not a refinery shipment. It is a promise tied to margin requirements and expiration dates. When volatility rises, leverage positions unwind first. That does not necessarily mean long-term holders are exiting. It often means short-term traders are being forced out. During the recent drop, something unusual occurred. While futures prices collapsed rapidly, demand for physical delivery remained firm. Institutions continued standing for delivery. Contracts were converted into claims for real metal. This behavior sends a message. If major players were concerned about structural weakness, they would reduce exposure. They would avoid taking delivery during instability. Instead, they accumulated. That suggests they view price declines differently than retail traders do. Retail participants often interpret falling prices as danger. Institutions frequently interpret them as discounted acquisition opportunities, especially when fundamentals remain intact. The divergence between paper pricing and physical demand is not new in commodity history. It has appeared before major revaluations. In such moments, futures markets reflect liquidity stress. Physical markets reflect strategic positioning. For business leaders, this distinction carries strategic importance. Silver is not just a monetary hedge. It is also an industrial input. It is embedded in electronics, energy infrastructure, medical equipment, and defense technology. Physical demand comes from real-world production requirements. If industrial demand remains steady while futures prices swing violently, it suggests the volatility is financial, not structural. Entrepreneurs who rely on silver as an input must understand this. A futures crash does not automatically mean long-term supply abundance. It may represent temporary leverage compression. Another critical factor is inventory behavior. When delivery volumes rise during price weakness, it implies that metal is leaving exchange warehouses. Each delivery reduces available supply in centralized vaults. Over time, sustained withdrawals tighten float. A tightening float combined with renewed demand can produce sharp upward repricing. This pattern has repeated historically across commodities. The paper market can suppress price temporarily. It cannot create physical supply. Eventually, physical constraints reassert influence. This is why seasoned capital allocators monitor warehouse levels and delivery statistics as closely as price charts. They recognize that derivatives markets can overshoot in both directions. The silver plunge may have looked decisive, but decisive moves in leveraged markets often represent exhaustion rather than initiation. There is another element to consider: geographic pricing differences. When regional physical markets maintain premiums while futures exchanges fall sharply, it signals that local demand remains resilient. Such divergences rarely persist indefinitely. They resolve either through paper price recovery or physical demand contraction. In periods of macro stress, physical demand often proves more stable than leveraged positioning. For aspiring business leaders, the lesson is broader than metals. In any industry, there's a difference between financial volatility and operational reality. Stock prices may swing, commodity contracts may fluctuate, but underlying demand for real goods follows economic fundamentals. Understanding that distinction separates reactive decision makers from strategic ones. Part 3 is not arguing that futures markets are irrelevant. They provide liquidity and price discovery, but they are influenced heavily by positioning, leverage, and short-term capital flows. Physical markets respond to supply chains, production needs, and long-term planning. When the two diverge, the gap becomes informative. The recent silver event revealed such a gap. Paper contracts fell sharply. Physical accumulation continued. Delivery volumes held firm. Industrial demand drivers remained unchanged. This does not guarantee immediate upside. Markets can remain disconnected longer than expected. But it does highlight structural tension beneath surface volatility. For disciplined observers, tension creates opportunity. They watch whether inventory declines persist. They monitor whether premiums remain. They observe whether futures prices stabilize above key structural levels. If paper markets attempt to drive price lower, but physical demand absorbs supply, the imbalance eventually resolves. And when resolution comes, it often arrives quickly. The 10% plunge was visible. The quieter story was accumulation during weakness. That is the invisible divide, and it may define the next phase more than the crash itself. Every major market cycle eventually reaches a point where policy becomes the dominant force. Not earnings, not headlines, not speculation, policy. The silver plunge and gold's rejection happened inside a larger constraint, a constraint facing central banks. They are trapped. On one side, inflation pressures remain persistent. Energy costs are unstable. Supply chains are fragile. Fiscal spending remains elevated. If policymakers cut rates too aggressively, inflation expectations could accelerate. That would weaken currencies and push commodity prices higher. On the other side, economic growth is slowing. Higher borrowing costs strain households and businesses. Debt servicing becomes heavier. If central banks raise rates further, recession risks increase. This is the dilemma. In previous decades, central banks had flexibility. Inflation was low and stable, debt levels were manageable, globalization reduced production costs. Cutting rates during crises did not create immediate inflation spikes. Today, the environment is different. Public and private debt levels are significantly higher. Governments rely on stable bond markets to finance deficits. Even modest increases in yields raise fiscal pressure. At the same time, geopolitical instability threatens commodity supply. In such an environment, monetary policy loses room to maneuver. Markets understand this constraint. That understanding changes capital behavior. If investors believe central banks cannot respond effectively to shocks, they begin reallocating capital toward assets less dependent on policy credibility. Hard assets benefit in that scenario. Gold thrives when real interest rates are uncertain and policy confidence weakens. Silver, due to its dual role as monetary and industrial metal, often follows with greater volatility. The recent bond market reaction provided a warning sign. Instead of absorbing fear, yields moved higher. That implies investors demanded greater compensation for holding government debt during instability. Higher yields increase borrowing costs across the economy. Corporations refinancing debt face higher interest expenses. Real estate financing becomes more expensive. Consumer credit tightens. For entrepreneurs, this environment demands caution. Business models reliant on cheap credit become vulnerable. Expansion strategies dependent on low-rate financing must be reassessed. Cash flow discipline becomes more important than growth projections. At the same time, commodity volatility increases input uncertainty. If silver remains structurally supported due to industrial demand and monetary hedging, manufacturers face cost unpredictability. Central bank paralysis amplifies both risks. If policymakers cut rates, they risk fueling commodity inflation. If they hold rates high, they risk slowing economic activity. Either path introduces instability. Markets are forward-looking. They begin pricing these constraints before policy decisions are officially announced. That is why gold's structural strength matters. Even after rejection at resistance, it held elevated levels. It suggests that capital sees ongoing uncertainty, not resolution. Silver's correction, when placed in this context, looks less like collapse and more like recalibration inside a broader uptrend attempt. There is another layer to this policy trap: currency credibility. When central banks appear constrained, confidence in fiat stability weakens. Investors diversify. Some move into foreign assets, others into commodities, some into precious metals. A gradual erosion of confidence does not create immediate crisis. It creates persistent volatility. Persistent volatility changes corporate planning cycles. Hedging strategies must expand. Risk management becomes central to operations. For decision makers, the key question is not whether silver will rebound tomorrow. The key question is whether the macro environment supports sustained hard asset demand. Several indicators must be monitored. First, bond yields during geopolitical stress. If they continue rising instead of falling, the safe haven transition strengthens. Second, gold's behavior near major resistance. Repeated tests without structural breakdown indicate durable demand. Third, central bank communication. Any hesitation, delay, or policy contradiction reinforces perception of constraint. Fourth, industrial demand indicators. Silver's long-term floor depends on both monetary and production needs. Invalidation conditions must also be defined. If inflation falls sharply and growth stabilizes, policy flexibility returns. If bond markets regain strong demand during crises, traditional patterns reassert themselves. If gold breaks below structural support and remains there, confidence in hard assets weakens. At present, those invalidation signals are not dominant. Instead, the system appears stretched. The silver plunge was dramatic, but it did not occur in isolation. It occurred within a macro environment where policymakers face limited options and capital is quietly reassessing risk. For the business community, this is not a moment for emotional reaction. It is a moment for structural evaluation. Debt exposure must be reviewed. Liquidity buffers should be strengthened. Input price risk must be hedged where possible. Strategic reserves, whether financial or material, become more relevant. Cycles shift gradually, then suddenly. If central banks remain constrained and bond markets fail to regain unquestioned safe haven status, hard assets will continue competing for capital allocation. The 10% silver drop may be remembered not as the start of weakness, but as a volatility event inside a larger transition. Policy traps reshape economic landscapes, and those who recognize the trap early position themselves differently than those who wait for confirmation. The market has delivered a warning. Whether it becomes a turning point depends on what policymakers and capital do next.